Good evening, everyone. Can you believe it? We are here. We are at the end of 2024. I want to say thank you to everyone who signed up for this webinar. I also want to say thank you to everyone who's attended our webinars this year. I see lots of familiar names on the participants list. Lots of people signed up for this webinar, which I was kind of surprised by, to be honest, just because of the timing of the year. We've reached out to quite a few investors over the past several weeks just because we've been working on some projects and a lot of people are traveling and doing things. So I was excited to see that there was definitely a lot of interest in this particular topic. So I'm excited to talk about tonight. We're going to talk about real estate resolutions, how to find success in 2025. And this is kind of a spin on New Year's resolutions in the sense that we want to set goals for the year, right? New Year's resolutions are a really popular thing. A lot of people set resolutions. Unfortunately, they don't often keep them, which is, in my opinion, why I don't set resolutions. I set goals for myself, right? I set goals on the types of habits, the types of behaviors, the types of things I want to do going into the new year. So I don't ever have to feel like I'm breaking a resolution. I'm setting a goal and I'm trying to accomplish that goal. It's not a temporary change, it's a permanent change. It's a lifestyle change, right? Or it's a habit change. So we're going to talk tonight about how you can find success in 2025. So if it's your first time joining us for this webinar, welcome. I'll talk a little bit about us here in a second, but welcome to the webinar. Hopefully you find lots of value and get lots of education in tonight. And let's go ahead and get started. If you want these slides, please reach out to me directly. You can text this number, 281-559-7061. Just send a text, say, hey, can you send me over the slides? So also share your email address. I'll be happy to send these over to you. You can also email us directly, somebody on our team, investor@headwaycapital.us. We are happy to share these slides with you. Just a quick, easy disclaimer. We're not offering or soliciting any investments here. This is just educational advice or opinions. We're just providing education, right? We're not selling anything. And you should always contact your attorney or financial advisor, CPA, for any technical questions you might have before making any type of investments and how it might impact you personally, including your tax situation. A little bit about us. I see lots of familiar faces or familiar names, I should say, in the participant list. But if it's your first time here, my name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. If you don't know who we are here at Headway, our firm was created to help build and protect the wealth of busy professionals. They want to invest in real estate, but they don't have the time to invest in real estate, so they partner with people like us. So our mission is to offer investment opportunities that provide cash flow, equity appreciation, and tax benefits to help you, the investors, achieve your ultimate financial goals and achieve financial independence. We have lots of years of experience investing in real estate, both residential and commercial, and have weathered various market cycles, including the one we're in today. Sid Shamim is our founder and CEO at Headway. He started investing in 2011 in residential real estate, graduated to passively investing in 2014, 2015, and eventually did his first deal as an operator 2017, 2018, and we were off to the races. So we are just now passing about almost our 7-year mark, which is crazy. Time flies. Anama Omer is his beautiful wife. She's a physician by trade full time, but she helps with some business development. She helps bring in quite a number of investors into our space that are in the healthcare space just because of our practice. So she's a great, valuable asset on the team. And then Mr. Umar Nakvi is our CFO and investment officer. He's the numbers guy that makes the whole thing go. So he's the guy sort of steering the ship, so to speak. If Sid's the captain, he's the guy actually with the two hands on the wheel. He's looking at all our numbers, all our reports, and he has a tremendous wealth of experience at a very large company before, doing multifamily as well before he joined our team. So we feel very blessed to have him on the team the last year and a half or so. My name is Brian, as I mentioned. I started off in the commercial real estate space in 2020, but before that, I was doing residential real estate for a couple of years. Like a lot of people, I see familiar names that were doing flipping and buying rentals before that. I got tired of it, and I wanted to transition over to commercial real estate. So I looked at my wife at the end of 2019, which is crazy because that's 5 years ago, probably 5 years ago to this week, maybe even to the day that I had this conversation with her. I was like, hey, I think I'm going to jump into commercial real estate with a focus on multifamily. And she looked at me and all she said was, well, don't lose all our money. So here we are 5 years later. I have not lost all of our money. And my specialty is talking to investors, providing good customer service, and getting people to be educated on what they're actually investing in, trying to make things as easy to understand as possible in a space that's often very confusing for somebody who's new, who's never been in real estate before. Just like I was, 7 years ago, I was probably where you are, or maybe almost 8 years ago. I was probably where you are, thinking about investing in real estate, didn't know all these technical terms, didn't know about the pros, didn't know about the cons, didn't know where the landmines were. But I just dived right in, and the best way I overcame that is by educating people. So I love to educate people. That's a big part of my responsibility here at Headway. Headway difference. So the four of us are the major core team. We provide the Headway difference, and it's a little bit of our track record here. See how much AUM we have. We've done lots of deals, 2,800 plus units, and we target a 25 to 30% average annual return. And we have over 500 investors that have invested with us in the past. You'll see here some of our very heartfelt testimonials, which is always very flattering to us when we reach out and either get them involuntarily and people say, hey, I want to just say something nice about you guys, or we ask for them and they have great things to say. So this is always great for us to see. And then a few case studies here. I need to update this because we've done 2 deals this year. I should probably put these on here. But these are 3 deals we did prior to this year. The Edge, Esperanza, and Watermill. Just you can see the different types of assets that we buy. You've got some older properties, like Watermill, that's a 1960s property. And you've got 2 newer properties here that were built in the late 2000s. This one's 2018, I believe, and this one is around the same vintage. So these are newer assets. So we definitely have a variety in our portfolio, but we're really looking for good value. So we want to buy things at a good price, and we want to buy quality assets in quality areas. And this is still workforce housing. So even though these are nicer, newer properties, they're still in workforce areas, and we bought them at a price that makes a lot of sense. So just some examples there. So let's dive right in. Why are we here? I'm going to go off here so you guys can see my full screen here. Real estate resolutions, how to find success in 2025. Again, really excited about this topic. I want you to be thinking about, your personal resolutions, of course, or your personal goals you're setting for yourself. One of the things that I do, and we're not doing a goal setting session here per se, but one of the things I try to do on an annual basis is before a new year begins, I will sit down and I will carve out an hour or two. Usually takes me 2, and I will set goals for different areas of my life, personal goals. And by personal, that's a pretty broad umbrella. I've got fitness goals. I've got spouse goals, how goals I want to set for me and my wife. I've got personal financial goals, right? I'm a new dad. I have a 10-week-old daughter at home. This is going to be the first year I set dad goals, which is, new for me. And then I set business goals, right? So whether you're a W-2 employee, and when I was previously, I had a long career in the restaurant industry as an operations advisor on the corporate side. I used to set business goals that even though I wasn't running the company per se, I was in charge of multiple locations, and I would set goals for myself as an employee, right? Now, as an entrepreneur and as a real estate investor now, I'm encouraging you to do the same thing, right? So sit down, set some personal goals, set some real estate goals, and set some investing goals for yourself going into 2025. What do you want to try to accomplish? Because if you're not measuring things, you're not going to be able to manage things, right? There's a saying that you can't manage what you don't measure. So if you don't set some good, smart goals for yourself, you're not going to be able to achieve success in 2025. And before you can find success, as I'm mentioning here, you have to set these goals, because if you don't, you're going to be that guy, as I like to say, who says they want to invest in real estate, but they never do. If there's probably plenty of people on here that have been to some real estate events, and because I've been in the space now for 7+ years in real estate and almost 5 years in multifamily, which is crazy. There's people you just see at these conferences, right? Whether they're active, passive, whatever, or they're vendors who tell you they want to be passive, or vendors who tell you they want to buy their own deal. And maybe that's you, and that's okay if it is. We're not picking on anybody here, but eventually you have to take action, right? You don't want to be the person who keeps showing up to events and saying, maybe next year, maybe next year, maybe next year. And look, here's the reality. There's always a reason to not do something. So can you find the reason to do something, right? I mean, I could literally think of 1,000 reasons at any year. I mean, name a year. 2020, I can give you a list of reasons to not invest in real estate. 2021, I can give you another list. 2022, I can give you another list. There's always a reason to not do something, but you have to find the reason to do something. And you have to do it for yourself. Otherwise, you're going to be that guy. So that's our goal for today, is to try to get you to not be that guy, the person who never invests in real estate. So step 1, in my opinion, If you're going to be successful in 2025 with your real estate goals, is you have to set them. You have to set those goals and you have to lay a strong foundation for yourself. So everyone on here is pretty educated, pretty smart. You've probably heard this acronym before, but I'm a big fan of this. And we use this philosophy at our company here at Headway when we're talking about goals. If one of our we had our like I had my assistant, for example, set some goals about a week ago, and she emailed them over to us. And Sid and I were conversing with her back and forth via email, and we're trying to get her to understand SMART goals, right? Because you can set a goal and say like, I want to lose weight next year. Well, that's a cool goal, but it's not a SMART goal. A SMART goal would be specific, measurable, achievable, relevant, and time bound, right? So specific is saying I want to lose 20 pounds next year and I want to lose 5 pounds per quarter. So it's achievable. It's less than a pound. It's about a pound a month, a little over a pound a month. And I want it to be relevant, right? So it has to be relevant to you. You want to get in shape. You want to be in, better, live longer, that kind of thing. And it's time bound. I'm setting quarterly goals and I'm setting annual goals, right? That's a SMART goal. So you want to try to set SMART goals for real estate as well, if you can. And why is this important? I think this is important because we're going to continue to see opportunities for discounted real estate. I think they're coming. To be quite frank, I think they're already here. We're seeing some already. Some of our great passive partners are here on this call. I see a few familiar names that have invested us in our two projects that we've done this year. And those were both discounted investment opportunities. We were able to negotiate directly with the lender and really do something unique that you don't see very often. Now, while it won't be common, there will be some opportunities, I believe, from our group and other groups out there to find some really great price real estate. So you want to have these goals in place so you're not kind of caught off guard when they hit your inbox. So you got to set some goals now. And these are the questions that I really want you to ask yourself when you're setting these goals, right? Build goals around how much capital am I looking to place in 2025? That's a good question. And it's a good number to really be thinking about now versus later. And what happens sometimes when you don't think about this, and this is not always a bad thing, but I always find it kind of funny, is I get calls later in the year, around November, December, and people are like, "Oh, what do you got? I need to invest 150 grand, da da da, because I don't want to pay taxes." And I'm like, "Oh, this is something that just popped up," and maybe it did. Maybe they sold something and they had a capital situation, which is awesome. I love those calls. But sometimes it's just due to poor planning. People wait 10 months. They look at deals for 10 months and then go, "Oh crap, it's October. I need to invest in my deals to get my tax benefits." Right. So you want to ask yourself, how much capital am I looking to place in 2025? And then you can start to set small, smart goals, right? Maybe you want to invest in one deal per quarter. So if you're looking to invest, say, 200 grand, well, great. That would be $50,000 per quarter. So you can set a goal for yourself that I want to invest $50,000 per quarter. That's 200,000 next year. Or if you're investing 100 grand, maybe you want to invest in two deals. You want to invest in one deal for the first Q1, Q2, and then another deal in the second half of the year, right? Or if you're just planning to invest 50,000 in your first deal, that's okay too. Say, I want to invest in one deal before the end of 2025, or maybe you want to put less stress on yourself. Nobody likes writing big checks at the end of the year. It's not as easy and not as fun. It's always much harder. So maybe you set a goal that I want to invest in my first deal and invest $50,000 by October 31st, before the holiday season really opens up, right? But you have to set that goal now. Now, things change, of course. If you sell a house or get a windfall of capital, that goal can change. And it's okay to change your goals. I always say plan in pencil, not in pen, because things change. The question you next want to ask yourself is, am I looking for more cash flow or equity upside? And I think that's important because once you have your goal set on how much you want to invest, the question then becomes is what types of deals am I looking for? There's going to be lots of deals out there. There's always lots of deals out there if you know where to look. Some deals are more cash flow heavy. They're going to be more, potentially lower price. Maybe there's some sort of tax abatement where they're not paying property taxes, or maybe there's a lot of units to renovate and a lot of rents to bump. I mean, there's different plays that can generate cash flow. Or maybe it's an equity play. You're investing in new construction. There's no cash flow, but you're going to get a big pop at the end. Or maybe you're investing in an A-class deal. There's very little cash flow, and you're going to get a big pop at the end. But you have to understand what you're looking for, so that once you've designated, I'm going to invest, 50, 100, $200,000, whatever your number is, you now know what types of deals you're going to be looking for: cash flow deals, equity deals, or maybe you want a hybrid approach. You want a little bit of both. Or if you're investing in 4 deals because you're investing in 200 grand, Maybe two of them are big cash flow plays and two of them are big equity plays. Again, that all has to do with diversification, but you have to know what you're looking for. The next question, kind of alluding to what I was just saying, is you have to ask yourself, do I want to invest in value add deals or newer assets, right? There's a big difference between those two. Newer value add deals are going to have more cash flow. Newer assets are going to have mostly be an equity upside play, right? So it's important to know which one you're looking for. We really value the value add space, which I think everyone here knows. That's really what we do. Value add is important to us just because we like cash flow, but it's not for everyone, right? So it's important to understand what you're looking for so that you again can quickly say yes and no to things. Really, really important. Is my self-directed IRA ready to go? This is really important, and I see this all the time. People want to invest, they see a deal they like, and then they go, "Oh no, my IRA isn't set up. My funds aren't there yet." And they may end up missing out on the deal if everything is not set up with their custodian, or they may end up delaying the funding, which can cause a delay in closing for the sponsor. That's not good either, right? So if you are somebody who's on this call and you don't plan on investing into multifamily or to real estate using cash, and you can, if you don't know this is not a topic for tonight, but you can invest actually using an IRA. You just have to convert it to a self-directed IRA through a third-party custodian, and there's lots of them out there. But you want to get that process set up. Setting up an IRA, it's not easy, but it's not hard. It's just a little bit time consuming. There's a lot of questions, some legalities, the paperwork that the custodians all have you fill out. And that process can take, 2 weeks on a good day, more likely 30 days, right? So you want to have that all set up because typically once these deals open up to invest in, you only have about a 30-day window to make a decision, and you might not make the cut if your IRA is not set up and ready to go. And last but not least, do I have a list of strong sponsors I trust? I may emphasize the word strong. That's actually not the last one. We got one more, but do I have a list of strong sponsors I trust? If you're planning on investing, investing with all your money with one sponsor, there's some lots of investors that only invest with us, and we appreciate that. But we also have lots of investors that invest with other sponsors, and that's okay too. There's definitely some other quality operators out there. You just have to know how to find them, and you want to make sure you have a list of strong sponsors I trust, so you're getting strong deal flow. And we're going to talk a little bit more about that towards the end, about how to get on people's lists and things of that nature. But you want to make sure you set a goal for yourself of building a list of strong sponsors. So perhaps one of your goals is to add 4 sponsors to my investor list by the end of January, right? So you spend the first 30 days. There's typically not a lot of deals on the market the first 30 days. So you spend the first 30 days reaching out to a bunch of sponsors, getting on their lists, finding out where to find sponsors, and basically building your list so you see more deals. That's a great way to hit the ground running in 2025, right? Last but not least, this is the last one, I promise. Do I have the education I need to make smart investing decisions? So if you don't, you need to set some sort of smart goal for yourself to make sure you get educated, right? So if you're here and it's your first time and you're not quite sure about all the X's and O's that come with multifamily, and you don't think you're going to be ready if I were to put a deal in front of you tomorrow, that's okay. But what you need to do is get educated, right? You need to attend these types of webinars. You need to read books. You need to listen to podcasts. You need to come to our case studies and property tours that we host here in Houston. Do as much as you can to get educated and set a goal for yourself. Say, I want to attend one multifamily educational event per month for the first 3 months, right? That's a smart goal. It's time bound, it's specific, it's measurable, it's hopefully achievable, and definitely relevant to your investing goals. And then once March hits, you can say, now my goal is between March and October, I want to invest in 2 deals, 3 deals, 4 deals, whatever the number is for you, right? But if you don't have the educational knowledge and you don't have the sophistication to invest, well, one, I personally just going to tell you now, don't want to take your capital because we don't want to take the money of anyone who doesn't understand what they're getting into. And two, I think most sponsors would agree with that. That's very risky, right? It's very risky to invest in something you don't understand. You don't want to get FOMO, fear of missing out just because other people are doing it or other people doing it. Get educated. So this is how you lay a foundation, and this is how you set goals going into 2025. So hopefully, if taking notes on this or taking a screenshot, start today, start tomorrow. Be thinking about, I want to invest 200K next year. I'm looking for more cash flow. I would like to invest in value add. I don't think I'm going to be using my IRA. I know, Brian and Sid at Headway, but I want to find one or two more sponsors. And I feel pretty confident because I've been educating for the past 6 months. I think I'm ready to rock and roll. Awesome, right? But if you're missing any of those, then you need to set some smart goals for yourself to achieve these things. Maybe you need 30 days to set up your IRA. Maybe you need to set goals around deciding whether to invest in value add or newer assets. Maybe you need to set a goal to do homework. I'm going to spend 30 days researching value add versus newer assets and figure out which one's best for me. So again, goal setting is super important. So let's transition a little bit and talk about something that I think is relevant with your goals is the 2025 real estate trends to watch, right? So once you have these goals, and you're ready to roll, you feel like you can conquer the world, you've got your plan, you've got your business plan, you're ready to roll, you're looking for deals. Now, what are you looking for, right? What are the things that we think, and I think, you should really be paying attention to in 2025? Now, the list could be very long. I tried to keep it short and sweet and keep it to 5 things that I think I'm personally looking for. I mean, we can get super nerdy here and start talking about treasuries and bonds and, the national debt and GDP and inflation. I mean, I think we can get super technical here, but we're going to keep it simple and talk about some big kind of high level real estate things to keep an eye on. The first one, in my opinion, that I think is really important is residential real estate prices. So, will prices drop if rates drop? That's a huge question right now, right? If rates drop, will we see the overall demand for residential real estates go up? So far, we have not. There was a little spike in residential activity when the first rate cut happened back in September, but prices are still high. And because the treasuries have been very volatile, the interest rates are still relatively high, right? So they just did another 25 basis point cut yesterday. We'll talk about that here in a second. But will we see prices drop? That's a huge question because it definitely impacts multifamily. So this is something I'm keeping a close eye on, especially in the markets I want to invest in. So in Houston, in Dallas, and wherever you're investing in, you plan on investing in, be watching your residential real estate prices. Will there be a recession that impacts the residential market? If there's a recession, or if we're already in a recession, there could be an impact in pricing. Again, these are big things that I'm looking for when it comes to pricing next year. I am also keeping a really close eye on, because of this first one that we just talked about here, right? Residential real estate prices. Because of this, I am keeping a close eye on the demand for multifamily. So demand for multifamily, there's a lot of population growth in our markets, the markets that we like to focus on here at Headway, Houston being one of them, Dallas being one of them. Great, great population markets. We're always strong population growth here. And then we want to keep an eye on rental demand due to the affordable housing shortage, right? So right now, as mentioned, residential real estate prices are very unaffordable. It doesn't financially make a lot of sense for somebody in their late 20s, early 30s, unless they have a really good job and can afford a sizable down payment, or they can afford the payments on a monthly basis, which is hard for a lot of people right now. It doesn't make sense to buy a house. So a lot of people are renting by necessity, not renting by choice. So I'm keeping an eye on the demand for multifamily. I'm looking at population growth in the markets that I'm investing in, and I'm looking at rental demand because I know that right now there's a lack of affordable housing. So it's something really important to keep an eye on for 2025. Also, let's talk about interest rates, right? Will interest rates rise or will they go down? Now, the Fed fund rate technically has been cut, right? Technically, but interest rates are still up. Well, people are like, well, what the hell? How are rates up when funds are down? The Fed funds rate's down. Well, that's because the interest rates in our space, particularly when it comes to commercial real estate, multifamily in particular, has a lot to do with treasuries. It's not just, oh, the Fed just cut interest rates 25 basis points. Now my mortgage rate's down 25 basis points. It doesn't work that way. So the treasuries are huge. The 2-year treasury, the 5-year treasury, the 10-year treasury. These are things that you have to keep a very close eye on as a real estate investor. And if they're going up, that means your interest rates on your mortgages are going up. If you go, whether it's fixed rate or floating, obviously it's a different situation. But if I go buy a property tomorrow, even if I buy fixed rate debt, if the 10-year treasury's up, my mortgage interest payment's going to be up, even though it's fixed. Doesn't matter. When I go to finance and lock in that rate, I'm going to be locking in a high rate, which is not ideal. So we want to keep an eye on interest rates and see, will they be going up? Will they be going down? And what's their impact on financing? Because obviously financing is the largest piece of the capital stack. We love our investors, but we love our lenders too, because they write you a down payment, a check for, 65, 70, 75, 80% of the price. So we have to be in really good standing with our lenders. But high interest rates impact returns, right? And if we're paying too much for money for the loan, then that's going to push down returns for investors. So we have to keep a close eye on that. Loan maturities. This is a big one. And this has a lot to do with the distressed real estate I was talking about earlier. Lots of floating rate loans are coming due in early 2025. These loans were often financed at the peak of Q1 2022. So if you were in multifamily real estate back in 2021, 2022, the peak of the market was the first quarter of 2022. That's March, April. So in April 2022, I believe it's either March or April. I think it's April. The Fed did their first rate hike, where they started raising interest rates. Now, they didn't go from 2% to 8%, but they started raising interest rates, right? Money was basically free or negative before that. So if you bought then, you paid at the peak of pricing. Well, guess what? A lot of these deals were bought on what's called the 3-1-1, 3 years, and then 2 1-year options. The 3 years are up. If you bought in January, February, or March, or April, or May of 2022, your maturity is January, February, March, April, May of 2025. What's going to happen? If you can't refinance, if you can't sell, will the lenders take the keys back? Or will they allow you to modify your mortgage? Or will you be forced to refinance? Or will you be forced to sell at a price that you never thought you'd sell for? Or will the lender take them back and put them in foreclosure or a short sale? I mean, there's lots of questions that could happen here, right? But I think this is something to keep a really close eye on. Right now, lenders have been very flexible. They haven't been taking the keys, so to speak, or asking for the keys back from a lot of buyers because their books are all red. They don't have like 1% of their deals failing. It's the other way around. They have a very large chunk of their deals that are underwater, and it doesn't make fiscal or financial sense or operational sense for the lender to take back hundreds and hundreds and hundreds of properties across the US. They don't have the infrastructure to operate those deals, right? That's not what they're doing. They're in the business of loaning money. They're not in the business of managing real estate, whether it's office, multifamily, or any type of asset class. So that's why lenders have not been taking keys back. They've been flexible. They've been modifying loans. They don't want these properties, and they've been finding a way to make it work. I think that will continue to be the case going into 2025, but things change, right? So something to keep a close eye on. Last but not least, the Trump presidency and the new legislation coming in, right? What's going to happen with Trump back in office? He said a lot of things on his campaign trail, and business people are very optimistic. The markets exploded up until recently, right? When they found out that he won the election. But what's going to happen in the real estate space? Will they bring back 100% bonus depreciation? That's the one that I am really looking forward to the most, because right now there is a bill. I don't remember specifically where it's at, but it hasn't been passed yet. But they're trying to bring back 100% bonus depreciation. So if you're new here, it's your first time on the call. I don't want to get overcomplicated and spend an hour talking about that. But essentially, long story short, this year, 2024, the maximum amount of depreciation, bonus depreciation you can get, not depreciation, but bonus depreciation, which is essentially accelerated depreciation you're able to take year one of your investment versus having to take it across all 5 years, is 60%. Next year, as soon as the calendar year turns, it goes to 40%. Okay. So will they bring it back to 100? I have a strong feeling they may. Trump is a real estate guy. There's a lot of real estate people that have been pushing for this. So if they bring that back, that could be a phenomenal thing for real estate investors to be able to capture more depreciation on their investment. So a lot of questions beyond the legislation around depreciation are kind of up in the air. But this is the big one that I know I get asked about it most is people want back that 100% bonus appreciation, just because it can be so valuable long term from the tax benefit standpoint. So, last but not least, when we're talking about real estate trends to watch, and this is not a real estate trend, but I think it will impact real estate or potentially make you think more about real estate, is I want you to ask yourself a question. Can you trust Wall Street in 2025? Can you ever trust Wall Street? But let's talk about specifically in 2025. The thing that makes me nervous about Wall Street right now, and I'm not a big equities guy. I have some an IRA and some other small things, but I try to stay very educated on what's going on, even though I'm not a day trader, obviously, or anything like that. But the thing that always makes me nervous about the market is when I see report after report after report about all-time high, all-time high, all-time high, Tesla, Nvidia, the big seven, magnificent seven, right? Nothing goes up forever is my learning and my time here on this earth. So the question becomes, when will the market correct itself? Is it correcting itself now? Will we go into recession? Will it keep going up because people are very bullish on Trump? I mean, these are all things to be looking for next year and year into 2026 and 27. But can you trust it next year? So this is a big question to ask yourself, right? If you made a lot of money this year, are you going to continue to leave that money in the market? Are you going to redeploy it in the market? Are you going to liquidate some of that stuff and go to cash and look to invest in real estate? Some of it, and not necessarily all of it, right? You're going to start diversifying in real estate so that if a big drop happens, like it did, in many other recessions, I don't want to say necessarily 2008, but just if we get some sort of correction in the market, you don't lose, a uncomfortable amount of your retirement or your cash in the market. So it's just a big thing to be thinking about right now because it feels really good to buy Tesla and see it go up 20+% so fast, and buy Nvidia a year ago and have tons of money in your pocket because of that. But again, I've never seen anything that goes up forever. Things always correct. Over a long period of time, they will go up, of course, but there's corrections, and the corrections are where people get liquidated and panic sell. So just something to keep in mind. And the last question I want you to think about when it comes to 2025 real estate trends to watch, and this is something I threw in here because I get asked this question all the time, is it a great time to invest in multifamily? So let's kind of recap some of the stuff we've talked about. The Fed cut interest rates again, 25 basis points, which is the same as 0.25% yesterday. They dropped rates at a full percentage for the year of 2024. So they did a 50 basis point cut in September. Then they did two more 25 basis point cuts, leading to 1 full percent in the Fed fund rates being dropped. That's awesome, right? We want rates to be dropped. We just now need to feel the impact of those rates, and it will take time. As I mentioned, there's volatility in the treasuries, and there will continue to be short-term volatility. There are discounted deals compared to 2, 3, 4 years ago, right? I don't know about you. I like to invest when deals are on sale. That's a big thing to me. Single family homes are still overpriced. We talked about that a little bit, right? Something to watch when you're looking at market indicators because the rent and buy gap is huge. I'm still very bullish on multifamily real estate. The overall goal that I personally have with my investments: invest now, sell in 3 to 5 years when the market is starting to boom again, right? So now, having read all this and heard all that, you have to ask yourself, do you think now is still a great time to invest in multifamily? Again, we talked about, can you talk yourself out of investing in multifamily? Sure, I could throw up 5 bullet points on here on why you shouldn't, but here are 5 reasons you should. And you have to make a decision whether you think this is compelling enough for you. For me personally, I think it's a phenomenal time. I got into multifamily when prices were sky high, and now they're starting to come down. We've seen 30+% corrections. Well, I want to buy when it's on sale. I don't want to buy when things are sky high. That's, buy low, sell high. Very, very common practice, right? And, Warren Buffett says you should be greedy when people are fearful, and you should be fearful when people are greedy. Well, if there's a lot of fear in the market and blood in the streets, I wanna be buying then. I want to be investing. So personally, I still think it's a great time to invest in multifamily, a great time to invest in real estate. So how do you build wealth through passive real estate investing? How do you start doing that? How do you make it happen? And why passive real estate, right? Why should you even be looking at this? Well, one, of course, I think everyone here is pretty savvy. I see lots of familiar names. Passive income from real estate can help you accomplish your retirement goals. You're here because you want to make money. You don't want to be working till you're 65. Or if you're already approaching retirement, you want a little bit more security. You want to add some cash flow to your portfolio so you're not having to rely only on your equities or your 401k or your social security and things of that nature, right? Passive real estate provides cash flow, right? We've been talking a lot about that through dividend payments. Upside, of course, there's equity appreciation. Things may be down now, but just like things don't go down forever, things don't go up forever. They also don't go down forever. Real estate will rise again. Tax benefits, defer taxes. A huge reason we get a lot of calls. This is the moneymaker, in my opinion, because it's not how much you make, it's how much you keep. And there's just a tremendous amount of benefits to investing in real estate from a tax benefit. Now, not everyone could take advantage of all the benefits, but they're still really powerful tools. Diversification. Diversification in your portfolio to include passive real estate can lower stock market risk, right? We just spent a few minutes talking about, can you trust Wall Street? Well, if the answer that you have is no, I can't put all my eggs in one basket. I still like Wall Street. I still want to invest. It's going to be a part of my plan forever and ever. Awesome. I'm not asking you to put all your money in real estate. It's not what we recommend. But if you don't trust Wall Street going into 2025, now is the time to diversify. If you don't have real estate in your portfolio, now is the time to be taking a even harder look at this because of how high the equities markets is, because of how down the real estate market is. I mean, that's the perfect time to allocate some funds from one hand to the other, in my opinion. So let's talk about some strategies on building that portfolio, building that passive portfolio that you should really be looking at in 2025. These are, in my opinion, if I was a passive investor or if I was just getting started and I wish I could talk to myself, 4.5, 5 years ago, what would I be looking for right now? Because I probably would have no idea. This is what I would tell myself. Brian, go out there and look for distressed, discounted real estate. I want to find things that are on sale because, as I just mentioned, I want to invest when there's blood in the streets and it's harder, right? That's to me is the best time to invest. It's super hard to write a check, whether you're buying a residential real estate house, or you're investing passively in a multifamily deal, when the market's a little wonky, a little nervous, right? But those are the deals that end up often being the most lucrative because you were buying when everybody else was uncomfortable, when things were on sale, as we've been talking about. So it's important to go out there and find things that are fairly priced at a good discount compared to where they were several years ago. And ideally, they have some sort of distress. Now, they don't have to always be distressed, but if you can find assets that are distressed, that's even better, right? And there's different types of distress. We're not going to necessarily talk too much about that tonight, but you've got operational distress, just bad management. I love those. You've got financial distress. They bought a floating rate loan in 2022 and now it's come due and they can't refinance and they can't afford a rate cap. Well, they have to sell. Well, that's distress. I love that. I want to buy it at a discount. I want to buy it for the note value. I want to buy it for the loan value or really close to it or under it, right? So now's the best time to find those deals. In my opinion, if 2025, I would be focusing more on workforce housing. So your workforce housing, if you're not quite sure what that means, there's different types of workforce. There's different types of industry terms. So workforce housing is going to be your B class properties and your C class properties. This is workforce housing. So B and C class, 1980s, 1990s, 2000s housing. That's there's like a 30-year window. Of course, 1960s, 1970s is workforce housing as well. That's your C class properties. But your B class properties are typically going to be your 1980s, 1990s, and 2000s plus product. Your C classes are often going to be 60s, 70s, maybe early 80s, but typically 60s and 70s properties. I would be focusing on workforce housing because right now we're seeing a big slowdown in permit pulling for new development, specifically here in Houston. And I personally believe there's going to be an appreciation in existing assets because of this. So let's just back up a second and say, Brian, what are you talking about? What does that even mean? Right now, we're seeing a slowdown in the amount of new developers that are pulling permits to start new construction buildings. New construction on multifamily takes 3 years. So if they're slowing down the building process and will not revamp until things get more stable, let's say 12 to 18 months from now, 2020, late 25, maybe 26, maybe even 27. Well, by the time 2028 hits, or 2027 hits, there's going to be no new properties hitting the market. That's good news. That means that my existing assets, whether they're 1960s or 2000s, doesn't matter, are more valuable because there's less and less new construction. It also means that my ability to improve rents is stronger because I'm not competing with newer properties that are offering 2 weeks free, 1 month free, 30-day move-in special. Concessions is what we call them in our space, because they want to get those new properties filled up as fast as possible so they can refinance it or they can sell it, right? We don't have to compete with them. Well, that's good news. So I want to be focusing on workforce housing because I'm a long-term investor. I'm thinking long-term. People get too caught up in what's going on today. What's the exit plan? I always want to know what's the exit plan. And selling a property that's 80s, 90s, 2000s when there's nothing else on the market, nothing new on the market, it becomes more attractive in 3 years, in 4 years, in 5 years. So I'm thinking more, what is my exit plan in 3, 4, and 5 years? Next, I am thinking about, I kind of already talked about this, the long term, right? Things will be very different in the long term. And that's something I always want to highlight. What's going on today is not indicative of what's going to go on in the future. So always make sure you're investing for the long term. There's no quick, easy money in multifamily. Personally, I'm focusing on cash flow. And to me, cash flow is my safety net. I want to use cash flow to stabilize my personal residence, my house, my family, right? And cash flow, forget that, is even more important for the safety net of the business, the property, right? When the property has a significant amount of cash flow, I know we're in a good spot, right? I want to focus on deals that are cash flowing. Now, some investments are going to be more IRR driven. They're going to be more equity upside driven. If you were investing in a new construction land development deal or something that doesn't have cash flow, those are great investments. I love them. They just don't have cash flow. That's not for me right now. To me, I want to see cash flow because to me, it's a safety net when things are a little bit rocky. And then last but not least, as a passive investor, I am focusing on proven operators because I think it's a risky time to invest with people that are new. To be quite honest, there's too many challenges in the market. It's too hard to buy. It's too hard to sell. And everybody talks about buying and everybody talks about selling, but nobody talks about operating. And that, my friends, is the hardest part of this business. Operating these properties is not for the faint of heart. Not easy. It takes thick skin. It takes a strong team. So if you've never done this before and you're not a proven operator, right? You've been through market cycles, you have a property management company or team, a strong asset management, you are going to have some hard times right now because if we have a recession, people lose their jobs. It gets harder to collect rent. You have to evict people. You have to get creative at finding ways to get them to pay their rent. Does your property management company or do you have the experience to do that? Well, the answer is often no with newer people, right? So I want to work with proven operators, which is something that's really important. And of course, I'm going to toot our own horn here a little bit. We've been doing this for some time. We've been vertically integrated and we've had our own property management company now for about 7 years. So we are battle tested, tried and true. And we know what we're doing when it comes to the operation side. So try to find firms like us, and of course, look to partner with us over here at Headway. So how do you find these investments that we're just talking about, right? How do we get access to these discounted distressed deals with proven operators that have cash flow? Well, first thing you got to do, and I'm going to emphasize the heck out of this, is you got to stay active. I mean, just so many people that I meet are just like, oh, I'm not investing. I'm sitting on the sidelines. Well, you're missing out on potentially good deals, right? So I never sit on the sidelines. Now, I might not be bullish about a particular time of the year or where we're at in a market or something like that, but I'm not sitting on the sidelines because there's always deals if you know where to look, right? And you have a thesis and you know what you're looking for. So, and also, even if you're not buying, if you're sitting on the sidelines, you're not connected to the market. You need to know what's going on in the market. Otherwise, how do you know what's good and what's bad or what's going on? So you got to stay active. You got to be looking for deals, right? That's super important no matter what. Get on investor lists, right? You're on our list. You're joining this webinar. That means you're on our investor list, right? Now, in order to invest with us, you got to get on a phone call with us. So we'll talk about that here in a second, but you got to get on investor lists, right? Of course, we're going to put out deals, but try to see if you could find other investor lists so you can look at a lot of deals, right? This is the best way you can find investments is you need to make sure you're getting a deal a week in your inbox. Well, in order to do that, You got to look at a lot of deals. You got to talk to investors, and you got to find sponsors. There's some great communities here in Houston. I'm happy to make some references. If you're looking for great communities that have access to these types of deals, I see several of our members are members of people and communities here on this call. But again, you got to get access to these investor lists and look at a lot of deals, because if you're not looking at a lot of deals, you don't know what's going to be good and you don't know what's going to be bad, and you're not in tune with the market. You're not active, right? Next, you got to build strong relationships with sponsors. You got to schedule that introductory call, right? I know too many people that they get on an investor list, they do this step one, and then they don't do step two. I mean, it's crazy. It's like you're getting out, you're signing up, you're saying you want to invest, you're saying you're ready to invest, and then you don't schedule that introductory call. And for us here at Headway, a lot of our deals are for sophisticated investors. So if you don't talk to me before we have an open investment, I can't take your. It gets challenging for me to take your money. I can't take your money, right? We have to have some sort of conversation. So you have to know me. You have to know one of our sponsors. You have to know somebody on the team in order to invest. So an introductory call is super important. And on that call, you're asking questions, and you're asking them, of course, to ideally send you their track record, right? Review each sponsor's track record of the list you're signing up for. What types of deals have they exited? How are their deals doing? Are there any deals that are in trouble? If so, how do they handle them? Just asking really smart questions like that, right? And last but not least, you gotta keep attending these types of events, right? You gotta attend webinars, events, property tours, case studies. We do all of these here at Headway. We have the webinar you're on now, of course. We do property tours and case studies. We launched last month. We had our first case study in December. That was awesome. That was a week ago, I believe. We're going to keep doing those going into 2025. So if you want to learn more about the education side of the classroom style education, keep an eye out for your email for these case studies. But we're not the only ones who do that. There's some great communities in Houston that are doing similar things. You got to make sure you attend as many of those as possible. I know it's hard to give up your day off or to request time off or go, to spend the evenings, 5, 6, 7 o'clock, to go out on the weekend and invest time on this. But I mean, you can't tell me you don't want to lose money and then not invest in yourself, right? If you're not investing in yourself and your education, you're increasing the likelihood of your potential financial losses, right? Because you don't know what you're doing. So it's really important. This is how you find these investments, right? You stay active, you talk to lots of people, you get on a lot of lists, and you start to look at a lot of deals. That's what's going to help you be successful in 2025. So I'm going to wrap up. And hopefully this was education. We're going to go to some Q&A here in a second. I see lots of questions flying in. But again, the goal for today was to talk about how do you find success in 2025, right? Step one, just to kind of recap, is you got to set some smart goals for yourself. Set some goals around how much money are you looking to invest? Are you looking for cash flow versus equity? Do you want to invest in value add or newer assets? Is my IRA ready to go? And do I have a list of strong sponsors I trust, right? You got to make sure you're educated too, of course, right? Then you got to stay in tune with the market. You got to be looking at the trends. You got to be looking at the data. You got to be looking at residential real estate prices, looking at what supply and demand is going on with multifamily. You got to be watching the Fed funds rates and the 10-year treasury and the 5-year treasury and the 2-year treasury and all that. You got to be keeping an eye on the market and what's going on with loan maturities, what's going on with the legislation, right? Lots of things to be looking at in 2025. And then you got to really get started, right? You got to understand what your strategy is going to be in 2025. I recommended looking at distressed real estate, workforce housing, and thinking long term with a focus on cash flow with proven operators. So if you do all that, you sign up, you stay active, you get engaged, you have phone calls, you talk to people, you go to networking events, you sign up for webinars, you're going to find success in 2025. You're going to find some deals that make sense for you. You're going to be able to invest in some deals that make sense for you. And you're going to find that in 3 to 5 years, you're going to be in a very good place. So that's my final statement for today. I'm going to first just kind of announce before we jump into Q&A. If you have not signed up for our private investor club and you want to invest with us, please do. You can do that on our website. Go to headwayinvestments.com. This is for sophisticated or accredited investors. We get access to all the stuff we just talked about, the member events, the real estate education, and the investment opportunities. And again, if you want these slides, text me 281-559-7061. So let's go into Q&A. If you have a question, please put it in the Q&A box. I have some questions coming in. Let me see which one we could start with. Let's see, best way. What's the best way to evaluate potential sponsors? Ooh, that's a good question. So there's lots of ways to evaluate sponsors. I think one of the main ways I like to evaluate sponsors is First of all, getting on a phone call, I want to get a feel for them because even though they might have an awesome track record, I want to make sure I'm vibing with what they got going on, right? Some people, not going to be they might be awesome at what they do, but maybe there's not a personality fit. And I want to make sure I know, like, and trust the people that I'm working with, right? So I want to get a feel for whoever's taking their calls, whether it's the CEO, director of investor relations, investor associate. I want to get to know them. Second thing is I want to review their track record. So if you ask them to send you a track record and they don't have one, that's a red flag to me, right? Why, if somebody's doing this for a long time and they're sophisticated and they have lots of investors, they have some content to share with you about how they've done in the past, right? Third, I'm trying to see if I can find ways to meet them in person. I don't know about you, but I have a hard time writing a check for somebody I have never met in person. Not the deal killer. Lots of our investors have never met us. Sometimes they meet us on Zoom, which is fine too. But I like to try to shake hands with people. If I can go to an event, a case study, a networking event, I want to do that. I'm going to sign up for that absolutely all day. After that, you got to start looking at their deals and figure out if their deals meet your criteria. We talked about setting goals for this year. If their deals don't meet your criteria, that's okay. It doesn't mean they're bad at what they do. It just means you're not a good fit for them and they're not a good fit for you. So that's what I would do, as far as evaluating sponsors. But good question. Good question, John. Let's see. How much capital should I set aside for passive investing? That's a kind of a loaded question. And since that everybody's answer is different, I will say the minimum investment for our projects is typically $50,000. So, for the year, you have to set at least a minimum of 50 because you're going to invest in one project. But knowing that, maybe you want to set 200,000 and you're either going to invest 50,000 four times or you're going to invest 100,000 two times. I will tell you, kind of side note, the amount of deals we do on an annual basis varies. This year we did 2 deals. Next year we might do 2 deals. We might do 4 deals. We might do 1 deal. We might do no deals. We have to go out and find these deals, right? So when they do pop up, you definitely want to jump on them, and it's up to you to decide if you're going to invest the minimum or you're going to invest over the minimum. But that's a good question. I can always happy to hop on a phone call with you, Craig, if you want to talk about that one. What are the tax benefits of real estate syndications? We talked a little bit about tax. Yeah, that's a good question. So you're going to get depreciation from investing in these projects through a cost segregation study, which is a study we do to basically see what on the property physically, asset wise, can we depreciate. Normal depreciation over the life cycle of most projects is 27 and a half years. We're not going to own this property for 27 and a half years. So what we do is called accelerated depreciation, and we force as much of that depreciation as we can over a 5-year window with an even bigger focus on year one. So what we do is called bonus depreciation, is we try to force as much of that depreciation as we can into year one. So for example, hypothetically, let's say you invest $100,000, there's a hypothetical potential that because this year the maximum is 60%, you could get up to $60,000 of passive losses from bonus depreciation year one. Hypothetically, that would be like perfect scenario. It doesn't always happen that way most of the time, right? But now those tax benefits, they get passed on to on a form called a K1. It's going to show passive losses, paper losses that you get to show to your CPA and that you can use to offset passive income you've generated. Okay, let me be very specific there. It does not offset your W-2 income. That's only works if you're a real estate professional. If you're a real estate professional and you're basically a full-time real estate investor, or you're in the real estate space in one capacity or another, then you can use those losses to offset your W-2 income or all income, I should say, from your real estate business. But if you're not, and you're a W-2 employee, you're an engineer, you're a doctor, you're doing something totally different, you can only use it to offset your passive income. So if you invest $100,000 and I give you $8,000 in cash flow that year, you can use it to offset that $8,000. So you defer the taxes and don't have to pay those taxes in 2025. It's a very powerful tool. Let's see. How do you identify high demand markets? So high demand markets for multifamily, good question. We look at population growth. We also look at absorption, right? So there's a thing in multifamily called absorption. This is basically how many units are being absorbed, exactly what it sounds like, or rented is another word to think about it, on a monthly, quarterly, semi-annual, annual basis. We want to see strong absorption in a market. So if somebody builds 1,000 units, hypothetically, new construction, and all 1,000 of them get absorbed, well, that's awesome. That means that there's high demand in that market. If somebody builds 1,000 units and only 300 of them get absorbed, that's a problem. That means there's not a lot of strong demand in that market. So we're always looking at absorption rates for multifamily. That's something you should definitely look at. We're looking at population growth for multifamily. I want to invest in a market that has strong population growth, not decline. And I want to invest in a market that I am personally comfortable with. And like I like investing in big name markets. So I don't mean big name like New York City. I just mean a name that most households know. It doesn't have to be, a top five city. But what I mean is like if it's a place you've never heard of and you have to look up where it's at, that's not always for me because that just means it's a tertiary market. If it's some city in Texas I've never heard of, I'm not a big fan of that personally. There's nothing wrong with that. You can make lots of money and cash flow in those markets often, but I like to invest in places I know I can sell. And it's easier to sell in Houston, Texas than it is in a tertiary market in Texas I've never heard of, right? So those are some demand drivers I'm looking for in multifamily. I'm looking for where businesses are moving. That's another one. If there's new jobs being created, those things are all important. What are the common mistakes new passive investors make? Oh, that's a good one too. There's a lot of one. I actually did a webinar on the 7 red flags for passive investing, and it talks a lot about this is probably a year ago. I need to redo it. Things that I see all the time, but I think the big one is jumping in without being educated. That's probably my number one, and I'll just focus on that one. You really have to get educated. These webinars, I know they're long. It's an hour. It's 5 o'clock, 6 o'clock, or you're watching a replay. You know, thank you for being here, but they really make you smarter, right? And they teach you how to think about real estate, even if you don't agree with something that I said, and that's okay. It's a lot of it's opinion. You at least can think outside the box. You're thinking a different way, right? That's the best thing about getting educated, right? So the biggest thing I see is people jump into it, they don't know what they're getting into, and they're like, "Wait a minute, you're telling me my investment isn't liquid? I can't get my money back? You're telling me you're holding this thing for 5 years?" Like, we don't do that. I try to make sure people that we take, their hard earned money that they're educated, but I've seen and heard stories before. That's a common mistake investors make. So getting educated, getting too excited, they think that every deal is a slam dunk and it's not. And they get so excited. They just, they jump in that first deal without doing their due diligence. You definitely don't want to do that. So that's all we got for tonight. I'm going to stop there. I want to say thank you to everyone. If you want to reach out to me, you can reach out to our team at investor@headwaycapital.us. If you want to reach out to me directly, just substitute that for Brian at headwaycapital.us. Again, you can text us at 281-559-7061. I want to say happy holidays, Merry Christmas, Happy New Year to everyone who's attended this webinar. I really appreciate, we have lots of our investors on this call. I appreciate you attending. We appreciate your investment. We appreciate your trust. And we're going to work our butt off to not only continue to provide great opportunities, best in class opportunities for you next year, but we're going to take care of your investments and look to be successful going into 2025. So thank you to everyone who's invested with us, and thank you to everyone who hasn't invested with us, but here is educating yourself. We look forward to hopefully working with you one day. Would love to schedule a call with you. Send me an email. Let's get connected. Let's plan to do some business in 2025. I'll answer this last question from Earl that just kind of came in. What is my typical deal size and how many investors do you typically have? Our typical deal size is 150 units plus or minus, typically 15 million to 30 million, sometimes more, sometimes a little less. And there's anywhere from 50 to 100 investors usually in most of our deals. So hopefully that answers your question, Earl. But thank you to everyone. Have a great night. Have a great holiday season. Stay safe, and we will talk soon.